Hello everyone, welcome to our October live stream about the PMS performance, what's happening in our portfolios, what is our outlook on the market and everything else. So with me I have Siddharth Vaisura, and we'll be taking you through a quick presentation, and then we will go to a live Q&A session. I think many of our investors have already given filled up the form, put in their questions, and then after that we also will take questions from the live stream. So very excited to have everybody here. Should we wait for a couple of minutes of that people to join in, or should we start?
No, I think we can start. People can probably just catch up over time.
All right. So this time I have a comprehensive presentation, and so because there's a lot happening in the markets right now, right? So
Absolutely. I think there's a lot of geopolitical tensions and crude oil is going up.
yes,
China
I
is,
actually, if you, Siddharth, if you look at the market, global markets everywhere are up, right?
yeah,
And Indian market is correcting, and actually, it's very difficult to pinpoint why it's happening. Is it the Iran tension, or is it the rate cut worries, or is it just because of FNO rules? It's a lot that's going around, right? So let's try to dig
absolutely.
deep into this a little bit. We'll start by talking about the performance, right? Uh, See, again, it's been 13 months, and every month that we cross, it seems like a milestone, but we have a long way to go. And I think what's very important is for us to keep up our performance month on month, quarter and quarter, and that is where people will be interested. And we've been doing did well this month. All our strategies beated the benchmarks, and we're holding strong. Our alpha strategy has been the outperformer. It has done, I think, close to 6% returns in August, where small and mid caps have taken a hit. Many sectors have taken a hit, and alpha has done extremely well. We've got more than 350 customers who have actually gone live with us. We've onboarded even more, and we're waiting for people to start. And very excited to see all the excitement that we are getting. Right, I think we have a unique strategy, very difficult, very different from what is out there in the market, and it's very exciting to see people look at that diversification and try to understand in depth what we've been doing. Right. In terms of AUM, we are at 290 right now, so I'm just rounding it up to 300. So we're close to 300 right now, and we see a long growth path ahead in this journey. Again, performance has been quite stable, and in terms of our focus, that has shifted to a combination of momentum and value right now, right? And we'll dig deep into those aspects in this presentation. So, firstly, talking about the gist of our three schemes. So, anybody who's new to the Wright PMS, if we offer three schemes in our PMS, the first scheme that we offer, all of these schemes, first of all, are quantitative. They are based on something that we call factor investing. What that means is that we're looking at different factors like, valuation of a company, or growth of a company, or quality of a company, or just the trend of the company, which we call momentum. And we're trying to allocate basis of those. In our first strategy, we actually try to find the best factor for the best time, and that's why it is a multi-factor strategy, and we call it Right Factor Fund. Apart from it, we have two purely trend-based or momentum-based strategy. Here we use a combination of price momentum as well as earning momentum, right? So here, if you look at it, we've been able to do quite well across our strategies. Because we've crossed a year, so we are not showing you absolute numbers here. We are showing you CAGR numbers for 13 months. Our factor strategy is the best performer, but alpha in the recent couple of months has really caught up. So, that's also something very interesting. Our momentum has also been doing really well for the past few months, right? So let's look at all these schemes one by one. You'll see factor, this is our biggest, most subscribed scheme right now. We have more than, I think, 180 crores deployed on it. It's very stable and, very strong performance. Uh, and You will see in any times of high risk or low risk, that strategy tends to be very, very consistent and has done well in the last month as well, right? In terms of momentum strategy, initially during February, March saw some correction, but then in the last few months, if you look at it, it's really caught up and again has done quite strongly in this month as well. Finally, our alpha has really picked up. If you look at this chart here, you'll see people were losing a little bit of confidence in alpha because of the corrections that happened in Feb and March. See, I think now we're all aware that since Feb and March, there has been a whole sector rotation that is happening in our economy, right? Everything that was working, for example, PSU banks, infrastructure, defense, and railways, and all of those stocks have taken a hit. They have seen corrections, and that volatility started in February, March itself. And right now, we're seeing more defensive stocks do really well, and that is where the allocation in alpha has shifted, and it's doing quite strongly, right? So it has pivoted this whole rotation in the recent few months, and seems to have picked up some good trends, right? These are the three strategies compared together. You will see, like I said, our best performer has been alpha, followed by momentum, and then factor. But strong performance across the board from our strategies. Now, so this was an overview of our performance and how the strategies have been doing. Let's try to talk about the type of research that we have been doing and what has changed in our strategies, right? So first thing to understand is that it is all based on factor investing. Like I said, we're looking at price trends, we're looking at earning trends, we're looking at historical growths, we're looking at valuations, we're looking at quality. And what we then do is, after identifying these factors, we try to compare how these factors are actually performing in comparison to each other, right? So some very interesting trends have happened. If you actually look at it, price momentum, which is based on the price trends, has actually underperformed for a good quarter, right? You'll see price momentum was beating everything for a while, and then it has seen some good correction. But on the contrary, if you look at it, your value strategies have been quite strong. You will see that your earning momentum strategies have been quite strong. So obviously, there's a shift that has happened in the market. And it's very interesting, and we, even though we have focus in momentum, we have avoided that deep correction that momentum has, because we focus on a combination of earning momentum and price momentum. I think, see, like we're saying, so many things happening in the market, and so many changes happening in the market, which is leading to this change in the momentum strategies as well. Now, another thing that we have done in our strategies is actually one change that we made in our strategies is actually differentiate between sectors to identify the sector rotation, right? So I'll just show you that slide. Um, so here, if you look at it, what we've done is we've compared the performance of defensive stock versus cyclical stocks for different factors. What you've seen in the recent few months is that the defensive stocks have really taken off in comparison to cyclical stocks over the past few months. The trend has been very, very clear, and we are adding that granularity into our strategies in a certain fashion to make sure that we are much more you know aware of such a sector rotation when that happens, right? So we saw some like our factor strategy had an underperformance last month, and that was because of this sector rotation, right? So to how do you incorporate the sector rotation? That's what change we have done in our strategy by adding that granularity. Now, another thing that has happened in our PMS is looking at how do you allocate money, right, for our investors, right? So whenever you will talk to investors, whenever you talking to clients, they will tell you that, okay, please deploy as per yourself, right? And Warren Buffett has given that big rule that you should be buying when there is fear and you should be selling when there is greed, right? But if you are looking at it as a normal person, and we do everything quantitatively, but when people give us that discretion, ki, Sonam, please invest when the market is at down, what I typically see is that I myself get into that fear zone. Oh, what's happening in the market? Should I deploy or not? So we again wanted to make a systematic procedure to deploy, and we created something that we call a fear and greed index, where we try to look at market momentum, stock price trend, advanced decline ratios, VIX ratios, even put call ratios, and combine them to create this fear and greed index. And when it is at a bottom, right, when we are in a lot of fear zone, we end up buying more. Whenever we are in a greed zone, we try to buy less, right? And if you have to sell, we try to sell in the greed zones. So this is a change that we have made in our strategy, and a lot of our newer investors also that will come and ask, ki, okay, you will deploy as per yourself, but what is the philosophy? So this is the philosophy behind it. And again, see, there is no, see, we cannot predict when the fear and the greed hits, but we see that these trends change quite often, right?
No, no,
In every
absolutely.
couple.
I think we get this question quite a lot of times. Ki, when should I put more money? The market is
Right.
falling or the market is rising. What should I do now?
Yeah. So even so that if you look at it in the recent couple of days, right, when there's been a lot of correction, and like I said, not sure why that is happening. It looks like the Iran situation, but global markets are not correcting, right? So
Correct.
we ended up buying during those couple of days because the market went into the fear zone, and we've done a comparison. If you look at it at the bottom, that in a, let's say you're buying every day versus if you're buying on the fear days, right? You will see there's a good difference in XIRR returns if you're doing that. So that's the philosophy that we are following in terms of deployment, right? So this is a brief overview of the research that we've done. We covered in the last live stream also that our sector shift has really happened as per the changing market condition, and it is when the strategy is running, you don't see this very drastically. But if you look at it on a year-long time series, you realize that how the strategy has shifted between these sectors depending on the changing market, right? So we've seen that our for example, PSU banking exposure has really gone down. We only have a very small exposure in the financial segment, that is for AMC. Our defensive allocation has been strong, pharma allocation has been strong, consumer has been strong, but for example, infrastructure and industrials has gone down, right? And that is because the market has shifted towards the defensive side. We see right now, in fact, uh, there's a lot of e-commerce exposure that we've added in our PMS, so it's all very interesting. In terms of factor, also if you look at it, we covered this in the last session also that we started with a lot of momentum. There was a little focus of quality and value in April and May, but right now we can see that there's actually a high allocation to value. So if you look at September ends, that there will be 50% allocation to value along with 50% to momentum, right? So like we saw in our chart, value is in fact going quite strongly. So that is as per about the research. Let's talk about the macroeconomics of it all. I think this is what the people want questions. So I'm sure the question that we have actually gotten, they're all about the macros, right?
Absolutely. They'll be about geopolitical tensions, the US elections, crude oil, so on and so forth.
Right. So we'll try to cover a few of these things. The big thing, obviously, is the rate cut cycle. I think this is the all encompassing trend. I think, see, the war situation we expect will be short term. Uh, even, what's happening is China might be a short term phenomena, but the bigger trend that is happening is the rate cut cycle that's going to impact the whole market. Even in the RBI, I think it's an RBI policy coming to that, but I don't expect RBI to cut rates right now because our they have a big focus on the fiscal deficit, and our banking system is going through margin compression. So we expect RBI might cut rate in December. They might go dovish right now, but yes, US has cut rate, and since then a lot of interesting things have happened, right? We are seeing crude prices and commodity prices rise after China made all those measures, and that will have an impact on US inflation again, right? So we have to be watchful of that. But in terms of the outlook right now, it seems like in November also we are going to see a 25 basis point rate cut, and maybe once more in December as well, right? But yeah, more than the recession, more than the rate cut, I think the bigger question is the recession. Will the US economy avoid recession? See, my read is that they might avoid recession because the rate cuts have actually come at the right time, and there are a number of, if you look at fast moving indicators for the economy. There is a mixture of slowdown as well as strong growth. So I sort of believe that they might avoid a recession, which means that economy will take off again after maybe 1 or 2 quarters when the rate cuts actually become much more. We've seen a whole lot of rate cuts. So see, the cycle is going to happen for the whole year apparently, so the effect will also come over the whole year. I think right now with the elections in place, with this recession fear in place, people might go to safer stocks for a while, but I think growth will going to is going to come back after a couple of quarters. In terms of our analysis, in terms of what happens after the rate cut, I think when the rate cuts happened, you saw a lot of news that came out which said ki rate cuts are negative, rate cuts are negative. But what's very interesting is that people typically just look at last three rate cut cycles, right, which have happened after 2000s. But in fact, if you go through the long history of rate cuts, you see that whenever the economy avoids a recession, rate cuts end up being a very positive event. And whenever the economy goes through recession, it's a negative event. So this time we expect recession to be avoided, but obviously there's a lot of data to be looked at, and it's a big macro issue. But that is what we sort of foresee, and we expect it to be a positive event, in fact. And like we saw this chart last week, last month also, but this is quite interesting, right? If you look at the rate cuts, initially when the 3 months and 6 months after the rate cut, you see value is the better performer, but quickly great growth sort of takes over, and this is what might happen if the rate cuts happen at the right pace, right? Another very interesting research that we had put out was that the pace of the rate cut is very important. Whenever rate cuts happen fast, they seem to have a negative impact. Whenever rate cuts happen slow, they seem to have a less negative impact. In fact, I was in a conference right before the rate cuts happened, and all the experts there were saying that we want a 25 basis point instead of 50 basis point. And I think this was the intention behind it. People want the rate cuts to be slow, but then we'll have to watch out for the data point to see how that goes, right? So that was about the rate cuts. Now the big question is the Israel in Iran war. This big escalation that has happened in the geopolitical arena. Now, see, like I said, we ended up buying buying when this happened, right? And it's very interesting. We hosted this webinar for our clients, right, that where we were comparing different countries, right? So I just put that chart out here as well, right? So in fact, see, you will see that while everything else, uh, every other market in the world has not crashed in the last 5 days, right? So if you look at this chart, you see that US market in fact recovered last Friday. It's been positive. China has ended up positive. If we add Nikkei to it, you will see that's also been positive, right? So seems to be an impact. This 5% correction that Nifty has seen seems to be a local impact. I think some domestic investors are selling. So not sure if this is happening because of the war or not. But talking about wars, there's a very good article that Siddharth has written on the Wright Research website on the war situation. If you actually look at different wars in the world, you see the market has had a positive return for some reason, even during periods of war. And we've seen the Ukraine invasion that happened, which was a big thing after a long time. Uh, and it even that had like a week long short term impact. After that, the market recovered in a strong fashion. We've seen very interesting analysis here that during times of war, the risk in the market goes down. I think people becomes risk averse. They are more attractive to quality or low volatility stocks, and therefore the risk in the market actually goes down in the times of war. And in the recent times, whenever we've seen any sort of escalation, it has been a shorter term impact. Now, again, we don't have expertise in geopolitics, and while we can say that it can be a short term impact, we don't know the level of escalation that it might go to. But again, uh, our read is that this could be a short-term impact. Therefore, we ended up buying a little bit during these corrections. One very important thing, and like you said that there are questions about this as well, that crude prices have really escalated uh, once this Iran war has happened. I think this is a big impact. I think China also has a role to play. All the stimulus package that China has done has led to a big uptick in crude prices as well as metal prices. So that will be something that will be changing the dynamics as well. If crude prices and metal prices increase, that means that commodities become expensive. Inflation could see an uptake. So, rate cuts in India might be delayed, rate cuts in US might become slower. So, again, we have to watch out for this quite proactively. Another big phenomena that is happening right now is China versus India, right? So when we hosted our client webinar, we saw many of our clients say, "Why don't you start allocating to China? Why don't you buy a Hang Seng index, or why don't you go to China-based ETFs?" Right? And why are people asking? See, China has been quite dead for a while. It's almost been in a recessionary sort of environment. And then the Chinese government announced a slew of measures. They said they're going to cut the rates, they're going to cut the mortgage rates, they're going to actually give out some freebies to the industry and to the people to sort of simulate some sort of growth in the economy, right? And that has led to a big, massive uptick. China market is up 35% since that announcement. And if you look at the news, people in India have started talking about, is this sell India and buy China, right? There's a competition that's going on, and people are speculating that are investors selling India to go to China. So, and again, if you read a lot of analysts and a lot of experts in this arena, what people are saying is that, okay, maybe incremental money that is coming in could go to China. Again, like we said, China was in a recessionary sort of zone, and while these announcements have been met with a lot of short-term positives, but how sustainable are they? Will they actually change the dynamics and actually take the economy from recessionary fear to strong growth? That is yet to be seen. So we're not sure if actually this is sustainable and money continues to go in China. But even if money goes to China, it's not like people are going to dump India and go to China, because India right now is the best market with the highest return on equity. Our growth rates are really strong, and it's an attractive country by itself. But yes, there are things that are changing in the Indian market also. To look at the metal markets, metals have taken a hike. Very interestingly, there's no impact on copper. Mostly gold and silver seems to be doing well. A lot of metal companies are sort of seeing a lot of buying because of these announcements as well, right? Now let's talk about another big thing that you see all over social media. Many experts, many analysts sort of keep on trying to talk about valuations, and how everything is very pricey. We have a different opinion here. We think there are certain segments which are actually very pricey, but then there are other segments in the market where we are seeing undervalue stock. We can actually buy at a good value. So that is where our outlook is. I think earnings are coming, and I don't know how many people follow earnings, but last quarter was in fact quite slow, right? We've seen a very muted sort of earning over the last quarter, and even this quarter people expect a very modest earning. We are not expecting anything to be very exceptional. And even on the economic front, you'll see there is a little bit of sluggishness in different aspects. For example, vehicle registrations are low, bank credit growth is low, and there are certain metrics which are low, but then you are seeing some metrics are being stronger as well, right? So it's a whole mix, but there is a little bit of sluggishness. I think this is because of the long-term impact of the high rates, and maybe like I said, maybe the earnings will also bottom out in a quarter or two, and then we'll recover from the bottom. When the earnings recover, your PE ratios will automatically go down. But we don't expect that recovery to happen this quarter. I think nobody expects that recovery to happen in this announcement that's coming in for earnings. But yeah, in terms of valuations, if you look at it, you will see that certain sectors in the market are in fact undervalued in comparison to the market. For example, from their long-term averages, for example, a bank, private sector, I mean public sector enterprises, autos are all undervalued compared to their long-term averages. Even pharma or FMCG are not extremely highly priced. Real estate is also, I think, undervalued, and we expect a very strong earning coming out of the real estate segment this quarter. So we actually have to be on a lookout for. We think IT will have some positive offshoots as well. If you look at earnings among autos, we might see, two wheelers do better and tractors do better. Pharma might give you good to moderate earning, and banks, there will be a lot of speculation around it, even though fundamentally they are the stronger ones, right? So I think it will be a very interesting earning season and a lot to learn, especially I think from the IT companies. uh, so that was our quick overview on the macroeconomics. We'll go over to the questions after we talk a little bit about how the allocations in our PMS have changed. So in our factor strategy, you will see that there's a very high allocation to slightly defensive industries. So you see pharmaceutical, household goods, this fintech, consumer, and you will have cements. We have fertilizers and chemicals also in this particular strategy. There's a little bit of metals as well, and e-commerce plays are also a decent part of it. In terms of our market cap split, you will see that it looks like we have large allocation to small caps, but these are the larger small caps. So if you are going by market capitalization, we have, I think, around 50-60% stocks above the 20,000 crores market cap, and I think rest of them are also, I think, more than 5,000 crores in market cap, right? So that's how the split is. But in terms of the semi categorization, that's how this looks like. In our momentum strategy, again, there's a big uh, shift toward defensive stocks, pharma, telecommunications, consumer durables, and airlines, and all that is there. We have a little bit of shipbuilding also in this, so there's a little bit of allocation to slightly riskier stocks as well. In our alpha strategy, something very interesting has happened, because see, because it is concentrated. So if you change three four stocks also, the allocation shifts a lot, right? So for example, right now it is extremely defensive. You see pharma, retail, consumer durables, consumer food, tobacco and cigarette, which is again defensive, IT, airlines, all defensive, right? So it's totally shifted. I think that's why it's doing really well, because of the trend change. In terms of market cap, again, it shows, as per SEBI definition, it shows high small cap, but these are large small caps, with many of them with more than 20,000 crores in market cap. So that was all from the presentation. Siddharth, let's go over, take some questions from the audience, right?
Sure. I'll start with the question that we have on the form, and then I think there's a bunch of questions that we've got in the chat as well. So anyone who's listening, please feel free to continue dropping the messages in the chat. We'll give them in sort of due course. So the first question I have here is from Ritik. I think he met you potentially at one of the conferences, Money Expo का event जो हुआ था. He just wants to know just about sort of quant finance, and he's looking at building a career in this sort of sector. So he's just wondering how can he sort of make that full shift, and what sort of guidance can he get to sort of learn more about this space.
So thanks a lot for that question. I tend to get this question a lot whenever I'm at conferences. I think, see, the what I really believe is that, see, there's a little bit of skill set that you will have to build, which will be probably in data analysis, right? And also you'll have to have an understanding of finance and capital markets. You'll have, I think, if you're passionate about these two things, you'll do really well. In terms of resources, you can, there's a lot of resources out there. Even on our website, Siddharth, we have a few courses, right?
Correct, absolutely. I'll share the link in the chat in some time. If anyone wants to check out the courses, you can do that over there. There's a question from Mr. Varad where he's asking, in his current portfolio allocation, he's got a few mid cap stocks, around about, let's say, less than 20% in the last few months. And he's got the mid cap index and MF, when he looks at it, have given decent returns. And they come with their own sort of set of risk and reward compared to, let's say, small caps or large caps. So he's just wondering, should he increase his exposure to the mid cap segment, or is there any specific reason why he should limit his exposure to the mid cap segment?
See, I think mid caps have actually seen a very good run up in the past few months, right? And well, I think you should have an allocation to mid and small caps. Maybe there could be a bias towards large cap for a little bit. I think, like I said, there's a tilt towards quality, there tilt towards defensive stocks in the recent times. So that so you can have a mid cap and small cap exposure, but then only if you sort of have a slightly long term view, right?
Sure. So here's a question from Mr. Chirag. He's asking about specifically about the PMS service, and he's wondering, one, on the taxation part of it, and two, on how, if there's a group of four people, how does the profit sharing work? How do they sort of go about setting up the account? Any sort of light you can shed on that will be great.
That's a very good question, and let me sort of clarify that. Right, number one, on taxation, it's taxed similar to your demat account. You pay long term and short term taxes. We give you a statement that you can use for advanced taxation as well as your final taxation. That's how this works. So 15%, I mean 20% short term tax, 12.5% long term tax. We to expect 70% of our profits to be short term, 30% long term. That's how it is. But even with that, you will see we expect a stronger performance in comparison to different longer term instruments, right? So that is that. Second question is more interesting. I think he has four people with whom he wants to open an account. See, we can have as many as three joint account holders in the PMS, and they don't have to be related or anything. You can be three people who created jointly, and you can add three nominees as well. Uh, but see, what happens is that we've seen many investors who've come in and said, three of us, three friends are going to open an account. But whenever the tax season comes to that, what happens is that in the ITR section, they see all the tax liability come to the primary holder or the first holder, right?
Mhm.
Now,
Okay.
what our CA tells us and what our expertise tells us is that you can actually you only pay a proportion, right? So if one person has put 20, another person has put 30, so they can split into two by five ratio, the 2:3 ratio. They can split the tax, and that's how they will pay, right? They can pay it proportionately, but then you will have to, if what will happen is income tax might send you a query that you can justify, right? You'll get a query, then you'll have to reply, and then it's sorted. But many people are scared about that, right? They get a little bit skeptical about it. So only if you're aware of that situation, then you should do a joint account. Otherwise, you'll face a shock when you do that. Second thing that is there is that you can actually do a partnership firm. At four of you can do a partnership firm. You can do an LLP structure. It's all easy to set up, and through that, you can have a split between your profits as per your capital contribution or however you want to do that, right?
Correct, correct. And if it's like a family, they can also do like an HUF or something, depending
Yeah,
on
yeah, yeah.
what's available. Right?
Right.
Cool. So then there's a question here from Mr. Kailash. He's asking about, he's got a certain amount of capital, which is not 50 lakhs. He's got a little less than that. The first question is, can he take benefit of the PMS service? Second is, can you shed some light if you have any sort of like indication of the new mini PMS that SEBI is sort of proposing or has proposed recently?
Right. So, see, first part that if you want to invest in the PMS, there's a SEBI rule that it can't start with less than 50 lakh. So, there are other parties involved in managing the PMS, for example, the custodian, which is Nuama, right? And the broker. So, what happens is they don't give us access to the account to operate until unless it has 50 lakh in cash or stocks. So that is the limitation here. But if you want to start slow, you can look at a number of small cases that Wright Research offers that are quite independent but follow some sort of a similar philosophy. You can look at an HNI quant, which is meant for slightly larger sums, so that might be a good idea to do that. Now the mini PMS thing, see again, very unfortunately, it seems like PMS managers are not getting access to that structure. Only AMCs or the large corporations, large AMCs, going to get access, and so but yeah, it should change the industry a little bit, especially in the specialized strategy, for example, long short strategy or derivative strategies. Those guys can pool in money and do a lot more interesting things, which probably many AIFs cannot do, and or if they do, they face a very high tax liability. So I think something is going to change in the market, but we'll have to see when it comes around. And obviously, we are not getting that access, it seems like. But yeah, I saw that APME, which is the Association of Portfolio Managers of India, they have actually made a representation to SEBI already that they want access to this structure, but we don't know what happens, right?
Correct, correct. I'm sure it'll take its own course of events. There's a question here from Nasr Ali. He's asking, is this the right time to enter, let's say, alpha prime small case, or and then by extension any other small case or any other portfolio in the market, as the markets are currently quite fluctuating quite a bit, and what is the right way of approaching it? Should it again be a typical SIP model, or should it be a lump sum model that they should follow?
I think it's a good time as any to buy. Like I said, our outlook is that the market itself closes positive for this year, right? And if the market closes positive, strategies that we follow, they can do better than the market. So I think it's a good time as any to allocate. Even our alpha prime small case or alpha strategy, all of them have been doing quite strongly. They have actually pivoted really well to to the trends that are working right now. So I would say, and I think, see, when there is a lot of fear, I think that is the good time to allocate, right?
Correct. Absolutely. And I think that's the period when most people don't want to allocate just because the market is so shaky. Here's a question from Mr. Varun and Kalpak. They're asking roughly similar questions. One is, what is the sort of primary difference between, let's say, the PMS portfolios that we have in the HNI quant advantage small case that's there in the market? And again, the right time to enter the PMS structure specifically, is this the right time for it?
So see, I think one big difference is the PMS we operate, right. So it's for you, it's essentially like a fund that you have bought. You get that account set up, you deposit money, and all the buying, selling changes we are doing, you have a view only access to it. On the small case front, in any small case that we offer, you have to do all the operations, but HNI quant has a lot of advantages. It is more limited access. It is need basis rebalancing. It is multi-factor with a slightly longer universe because people will have that advantage, right? So it is more similar to a PMS like structure. It's very independent, right? But yeah, it is more similar to a PMS like structure. But yeah, it's an advisory portfolio. So if you are looking to allocate it, but it starts with 5 lakh plus, right? So you can invest smaller chunks into that and build up a larger corpus there.
Sure. And I think Mr. Varun has just sort of dropped another message. He's asking specifically if there's any difference between, let's say, the shares that are being allocated or selected when you look at, let's say, the HNI portfolio or the PMS portfolios that we have. So is there a
No, no. So
fundamental?
see, it's not like the similar portfolio. There are differences, but there are commonalities as well, right? And this is not by design. I mean, this is not intentional, but these are independent strategies that run. They have some similarities, but they have differences as well.
Sure, sure. There's a question from Mr. Ambanch here where he's asking, can you share the performance of the right hedge fund PMS portfolio compared to the other any other funds or benchmark to see if there is an underperformance or overperformance of the portfolio?
You can actually go to, there are various aggregators, or you can go to the AppMe website and you can find the comparison of our performance with all the other PMSs, right? We actually, Siddharth, so there's an aggregator called PMS Bazaar which ranks PMS, and they have ranked us number two in the flexi cap category in the last year as per performance, right? Till September. So which is very exceptional that a new PMS in the first year is ranked two. I think it's a big positive for us, but yeah, there are a couple of which have done better than us, and I'll explain to you why that has happened, right? So, for example, we saw in the last 3 6 months there's a big shift that has happened toward defensive stocks. What we see is there are certain managers which only do defensive investing, which don't do anything in the cyclical side or in the B2G side. So obviously they have had that advantage, and maybe in the last 3 months they have beaten us by some bit, but it's a sector rotation that is happening. We don't expect this to continue forever, and I think the shift will happen again. But we expect our allocation to be strong going forward as well, right? So,
Sure.
so yeah, that's the explanation. And we as PMS managers, you shouldn't look at your peers that proactively. You should focus on your strategies, and that is where our focus is, right?
Absolutely. And I think just a follow up question on this, which is asked by Mr. Narendran. He's asking, can the sort of 80% returns that we've got in the last one odd year on the PMS side, can they be sustained across market cycles? What is your sort of view on that sort of returns that
See,
we've
I
seen?
don't see. I cannot tell you that we're going to give you 80% CAGR returns. No, that's not the case. When we did our analysis before we started the PMS for the last 10 years, we saw around 42% CAGR, right? And that is what our expectation is. We expect the next decade to be better for India, right? That's what the outlook is. But yeah, if it is similar to the last decade, we'll expect a 40% CAGR. We don't expect a 80% CAGR. So not every year you are going to get 80%. Right?
No, naturally. I think we're just approaching the end of the form questions, and I'll get to the chat. There's a question here from Mr. Vishru. He's asking, is there a multi-asset portfolio balancing equity, which includes, let's say, both momentum and the alpha strategies, along with, let's say, metals, debt, like a mutual fund in the PMS structure that we have? And actually, just on that note, there's a question from Finance Guru as well, where he's asking if there's any plans of launching a PMS portfolio that primarily invests in mutual funds, whether it be domestic or
Okay.
international. You can take it together.
Right. Right. So see, so as an investor in our PMS, you can take a split between our schemes. So with 50 lakh even, you can split between the different schemes that we have. You can say, give me 70% factor, 30% alpha, or maybe some debt, or you can say they're specialized to me, give me some gold exposure, or give me a multi-asset exposure, right?
Mhm.
That is possible, but yes, we are actually, we see what happens is that whenever we talk to clients, right, they will say, okay, put my money in this product that you're offering, but also give me advisory on my overall portfolio, right?
Sure.
Now, people like, for example, Deserve have been doing this very beautifully, right? Where they help people on the mutual fund allocations. Obviously, you see, I won't say that, we are the biggest mutual fund experts. So we are actually adding people in our team with some expertise in mutual fund. And we are launching a scheme where we'll be doing mutual fund allocation for our clients, right? On an ad hoc basis, right? So not everybody will have the same mutual funds, and you cannot sell mutual funds very frequently. But we
Sure.
are going to plan to do mutual fund advisory through certain scheme as well on an ad hoc basis.
Got it. Sure. On HNI, I've just seen a question in the chat and also on the form. I'll just try to put it together for you. One is from Mr. Venkat, the other is from Mr. Vishal. They're asking what is the maximum amount that they can keep in the HNI quant small case, given the current context of things. And the second question is there any plan of increasing, let's say, the number of stocks that the HNI quant small case is sort of investing in the future?
So HNI small case, Siddharth, right now, if I'm not wrong, we have around 100, investors. That's it, right?
Correct. About 130, 150 odd, yeah, in that range.
Yeah, so see what that means is that it's still, it's a very limited access. Only a very few people have access to it. We get on call with our investors. Like we hosted a webinar for them on Friday as well. So you don't have a limitation on the size that you can invest. Right, you can take it up to as high a value as you want, because you'll see that only 150 people have access to it. In comparison to that, so that if you look at our Alpha Prime strategy, there's something going on, right? Because every time we add a stock into that portfolio, we see there's a big uptake. I don't know if we are doing some very good stock selection, or if somebody is putting very big money following that strategy. If anybody has some clue, please do let us know. So yeah, so you see the difference, right? If this strategy being very limited access, you don't see the risk of prices running up and all that happening is much less. It's a need basis rebalancing, so it's not coming on a fixed time, and you can invest as much as you can want to do. Right? It's not very illiquid also, so you see larger stocks in the strategy mostly.
And I think just to reiterate, I think to Mr. Vishal, there's no such plan to increase the number of stocks in the portfolio just because I
Yeah.
think the 25 or 30 stocks that are there are is so the appropriate balance for it.
Correct.
I will move to the questions that we have in the chat. I have made a list of it. Let me just quickly run through them. So there's a question from Navneet. I think he's asked this question a few times in the chat. Why can't I renew a subscription that he's taken, let's say on the Smallcase platform, uh, where a coupon code was potentially available couple of months before it expires? Because he is always worried that the by the time the subscription comes in or the renewal comes in, there's no good discount code that's available. So any thoughts on that, Sonam?
Siddharth, I think you're the better person to answer that.
So yeah, so Navneet, I think that's just a function of how the small case platform works. There's no way of actually getting future subscriptions added on. The maximum that we can take, at least under the RIA license, was 6 months. We will at some point be moving to the RA model at some in due course. So in that we'll sort of see how that's available and what you can do. But unfortunately, there's not a lot that can be done at this stage. But needless, you can sort of reach out to the team and ask about any potential discounts that are available, and I'm sure the team can help you out with that. There's a question here from Mr. Finance Guru. I think he's asked a few questions. This is one of them where he's asking um, about the Indian markets, and he's wondering, given that the Chinese stocks have really taken off, and there's a sort of recovery that's happened there, will FII specifically be investing in the India story, and do we need it?
So I think that's the second question is more interesting. It doesn't seem like India market needs FIIs. I think the whole rally that has happened in the recent times, it's all domestic led. You're seeing so much SIP flow, so many investors jumping into the market, and with all the FNO changes happening, maybe there will be more liquidity in the equity market again, right? So do we need foreign investors? Sure, we do need it, but domestic market itself is getting stronger. Now, FIIs, will they sell India to go to China? See, they've been selling India for a while. Let's say if you go to the FII DI flow, you will see over the last 4 years, right? FIIs have actually been negative for some reason towards India, right?
Yeah.
So I don't think that so there's not too much money for them to sort of take out from India, uh, but yeah, I think incremental money could have a preference towards China, so that, but I don't think people are going to take money out of India to invest into China, right?
No, no, correct. I think it's probably specific to the FIA is only doing it, but it may not be a broader market sort of consensus in that sense. There's a question here from Mr. Anand. He's asked it again a couple of times. Can we present a monthly returns performance data for, let's say, the current calendar year between alpha and factor fund? Is
So
there a
it
way
is
that?
there. It was there on the presentation also, right? So let me just share this with you, Siddharth. Why don't you take this? I think my battery is about to die, so I just get my charger,
Okay,
right? But I
sure,
just
sure.
put it out, right?
Sure, I will.
Just give me a second. I just put out that chart for you. Yes. So here.
Great. So while Sonam is away, I will quickly sort of just talk about this and a couple of questions that have come in on the chat as well. So as you can see, Mr. Anand, here's the factor fund, the momentum fund, the alpha fund. You can find similar sort of returns and breakdowns of ours on the website as well. I will quickly just drop the link for you on the chat.
So,
Is the chat.
yeah, so this data is on our website as well. We presented it here as well. You'll see that in the last 1 year, January was amazing for most of our strategies, but February, March was a slight correction for alpha and momentum. Since then, there's been similar sort of performance, but in the last couple of months, our alpha has done better than factor, right? So that's how the story is going. But we're confident about the allocation across the board, right? There's a lot of research and a lot of tinkering that have gone around. We are very confident about the allocation going forward.
Here's a question from Mr. Rishabh. I think he's one of our existing investors, and Mr. Agarwal. I'm not sure if he's an existing investor, but one is on what is the difference between, let's say, factor and alpha. Could you just sort of shed some light, and how should an investor try to figure out allocation between the two? And then the follow-up question:
Yes.
is there a right time to top up given the current context? Is this the right time to sort of add more money in the
Right.
market?
Yes. So see, difference between factor and alpha. Number one, factor is a multi-factor strategy. So it is a combination of momentum and growth and all those factors. See, essentially what happens, Rishabh, is factor is a more diversified and more moderate risk. So we expect good numbers from it, but at a very consistent pace, right? We are combining all things, adding that diversification so that make sure we are doing well in riskier times also, and we are doing well in good times also. So this is the factor strategy. Alpha, on the other hand, is taking slightly higher risk. It is only 10 stocks. It is allocating to momentum factor, which can be very high risk, high return. So here you can expect a higher return, but with a slightly higher risk. So for example, this is a good place to understand that risk. February, March, factor is flat, but alpha has seen almost 13% correction, right? But it recovered very beautifully after that. So so that is the primary difference. As an investor, factor will be a much more consistent moderate risk strategy. Alpha will be high risk. You can actually take a split between factor and alpha. So for example, when I've invested, I've put in 75% into factor, 25% into alpha.
Correct. Um, Cool. So we've got a few more questions here. One is from Mr. Squidby. He's asking, he's happy with the performance. Gotten his family to invest in our small cases as well over the last 2 years. Again, he just wants to understand the right time to invest. Should we add? We've answered
Right.
this
So
question, but yeah,
yes, yeah, I think right time to invest. It's as good a time as any to invest. But yes, this because we have seen a good correction. I think Nifty has seen a 5% correction, right? Small caps have seen a deeper correction, so that might be a good time to actually allocate, right?
sure. There's a follow up here from Finance Guru again earlier in the chat where he's saying, "Do you think the RBI may not cut rates because of the upcoming festival season and potentially the end of the receding monsoon?" And that's probably could be one of the reasons why December is probably the ideal time for RBI to actually cut rates.
In fact, I've been reading a few research reports also. I think there's a consensus among analysts that RBI might not cut rate right now, but they might cut in December. And a combination of reason, I think the primary one being the fiscal deficit,
Sure.
and second one being the stress in the banking sector right now. So I think we that could happen, but given what happened in China, I don't know if India becomes competitive with that. So not sure, but there is a reason for them to delay it till December. Yes.
Sure. There's a question here from Mr. Anwar Laksh. He's asking for the fear and greed index that we were sort of talking about earlier. Have we done any backtesting over a 3, 4, 10-year horizon, etc., to see how that would have impacted potentially returns if we did follow or
Yes,
if we did
yes.
follow it?
Yeah, we have done a lot of backtesting on that index. Right? We published it somewhere, but we've done a lot of backtesting. Number one, to see the combination of factors that go in. Number two, to actually see how to allocate, right? So how much do we allocate when the market is in the extreme fear zone? How much allocate when it is in fear zone? How much to allocate in neutral, in the higher in the greed zone as well. So the what comes out is in the greed zone you should be actually selling, and then
Mhm.
you should be buying everything that you can in IPS in the extreme fear zones, and you should be buying in the fear zones as well. Right? So that's what our analysis has shown, and so we've done a lot of analysis from this, and the reason for it was because people just come and say use your discretion and buy when the market is down. And what I realized is, actually, if you look at the performance of our PMS, we were a little bit conservative, a lot conservative during May and June, right? So that's when elections were happening. There were a lot of things happening, And obviously that was a great time to buy. If you look at retrospectively, we did buy a lot during elections results, but if you have that index or slightly objective view in place, you could do that much more confidently, right? So I think this is a good addition that we've done in our PMS to much more objective in even how we allocate, right?
Sure. No, no, absolutely. Here's a question from Mr. Molek. I think we've answered this in other sort of live streams, but maybe you can shed some light on it. It's about rebalancing on a weekly or a monthly basis. And he's wondering whether a weekly rebalance, given market corrections, could see lower drawdowns. Um, was vis-a-vis sort of comparing it to, let's say, a monthly rebalancing scheme.
See, I think so. On the PMS, Siddharth, we actually do it on a need basis, so it can happen on a in the middle of the month also, or towards the end of the month. It's much more need basis. And yeah, see this question, this thing where whenever this sector rotation or a lot of churn happening in the economy, people start saying ki do weekly rebalancing, but that is counterintuitive, right? So I remember 2022, we got a lot of such requests. We ended up sending weekly rebalancing, but we had a version of the portfolio which was actually running live with monthly rebalancing. We saw big difference between the monthly rebalancing and weekly rebalancing because you shouldn't be panicking or taking too many interventions in such scenarios, right? There can be short term corrections and short term changes also. So, I think sticking to the longer term makes sense. But yeah, we are much more proactive, and if we see some bigger risk, we'll react on that, right?
I'm not sure. There's a few more questions on rebalancing. I'll try to club them together for you. So Shri Kumar was asking about if rebalancing, if you have a lot more funds are asked during rebalance, and if funds are not deposited, so that the shares are not bought, what happens? How should he sort of think about rebalancing? And then there's a follow-up question, another question here, sorry, on rebalancing, which is that uh, Mr. Sashi was asking what to do when you're rebalancing, but the prices go up by 10% in the morning of the rebalance. So, anything you can share on that for people?
So last question first. What I see is there are few people in my office also who invest into the small case, right? So what they do is they try to set an alarm at 9:15, and by at 9:15 they end up getting the stock before that rally happens. Again, see, so that I did an analysis where I pulled up data for all the alpha rebalances. So there is no statistical relation ki, every time we are hitting that stock price rises, but we're just observing it over the past 4 5 weeks.
Sure.
Not 100% sure if we are causing that price run up. What were the first questions that on the rebalancing?
It was asking if if there are more funds are needed on a specific date, and if they are not deposited, then what happens? Obviously, you can't buy the shares in that sort of context.
So see, when more see, typically we try to make that limitation ki, we shouldn't be adding capital so that in every rebalancing people don't need to add capital. But once in a while, if that happens, you can actually edit and manage, right? On Smallcase app, it's all under your control. You can manage, you can reduce a few shares for a particular stocks and make it within your capital and operate like that, right?
No, no, sure, absolutely. There's a question from Mr. Molek. Again, he's asking: is the right momentum strategy absolute momentum, or is it a rotational momentum strategy?
So it's a combination of different things, right? Yeah. It's a relative
Uh,
momentum, I would say, in a sense.
sure. In the three strategies that we have from the PMS, what is the best? Which is the one that's given the best returns in the last 1 month or the last 3 months? Again, a question from Mr. Rajiv here.
Yeah, I think Alpha strategy has done the best in the last 3 months, right?
Mr. Zamir Fadness is asking, I'm an investor in the right small case for around 20 months. Recently, he's been seeing some sort of slowing down of the growth of the portfolio. And he's just wondering if there's any update specifically on the
Small case, did I say? Did he say which one?
small case.
No, not really. I think that one has been a really good performer. There's been a slowdown in small caps themselves, where you might have seen something. But I think it's a great small case. And from when we started to now, it's been almost 4 years, and we've done many iterations on that. Seems to be. Look at last couple of years. It's been a very strong performer, right?
We're getting a bunch of questions. I'm just quickly trying to take them. So Mr. Basir is asking again. It's around investing in the current context, and he's asking if we should invest large caps, mid caps, or if there's specific sectors that you sort of think will do really well given the current state of the
So
markets.
see, I think as per our analysis and some wisdom from all the research that we're reading, seems like value as well as defensives might do good for a quarter or two. After that, growth will pick up. If you want to have a longer term allocation, investing into growth, mid caps, small caps is not the wrong idea. You can start accumulating at these prices. In fact, so short term, yes, be a little bit defensive, but long term, obviously, you can invest into small mid caps and all these funds. No?
Sure. There's a question from Mr. Hello Crypto. I think he's been asking us to ask this for a fair while, but there's just been quite a lot of questions here. He's asking whether we have any PMS that can sort of focus on buying Sharia compliance shares specifically, because
Yeah,
he
yeah.
wants.
So yes, so we actually are doing Sharia for one of our clients. They have given, they have identified the set of sectors where they don't want to invest into, uh, and if and then we saw another investor who came who said that they want to invest into Sharia, but they want different sectors. So we can do that for people, right?
Sure. Um, So I think there's a confusion around the 40% number that you shared regarding the backtesting. This is from Mr. Tarun. He's asking, when you say that the CAGR in the next decade would be 40%, while in this decade it would be 80%, how do we reach that conclusion?
And this decade will not be 80%. It hasn't been 80%. This decade, 10 years, our analysis has shown 40% CAGR, right? Last 1 year, we've seen 80%. Last 1 year was really good across the board. Last 1 year, BSE 500 gave you 40%, right? Almost.
Yeah. Yeah.
So, yeah, yeah. So, see, so therefore, if this decade has given you 40%, we expect economically we expect next decade to be even stronger for India, but so 40% would be a good estimate, reasonable, I assume. So we are not expecting 80% for a decade in any case.
Absolutely. Mr. Anwar Lash is asking if we can overlay the Nifty on our grid index. I think we'll be sharing something around it in due course, maybe an article or some research paper on it, I'm sure. So we can take that up then. Mr. Shubham is asking, could we shed some light on tax harvesting at the end of this year for stocks which are unrealized losses?
Yes, yes. So yeah, so see, we try to do that whenever, let's say, some of our investors try to do SWP, or sometimes they want to withdraw some capital, small profits they want to withdraw. So what we do is we try to sell anything that is loss making, right? And even at the end of the year, if we have loss making stocks, we'll try to cut them down and book those losses to reduce the tax liability.
Sure. So I think I have another three, four questions. I will quickly take those, and I am going to stop looking at the chat at this point because they're just coming in. Mr. Anant Divakar is asking if we have done a study where the PMS is performance, let's say against the MF, after churn of tax and any sort of other costs. Is there a way that we
So
can
that
actually?
data I have. So because we initially would get a lot of questions, specifically people asking us to compare with Quant Mutual Fund, right? Or with Parag Parekh, which is a very famous mutual fund, right? That's where I think a lot of people invest, in fact, from what I've seen. So let me show you that data. We show this to our clients. So this is again the back-tested comparison of our strategy with. I think there's some error that has happened, but if you look at it, I think it's updating the data somewhere. But while the CAGR for a quant active or PPFS, it's just updating, would have been around 25%. We expect a 40% CAGR because you actually have a lot of flexibility. And if you compare it on a live basis, right, so while in the 1 year that we've been live, see that again, these funds have done extremely well, 50%, 60% CAGR, but we have beaten them by a bit on a post-cost basis. So our strategies of the numbers we publish are post-cost. It post all the expenses, all the fees, and all that. Uh, So on a post cost basis, we have beaten the mutual funds. But yes, one thing to note here is that these funds, if you invest for 3 or 5 years, you'll have 12.5% tax, but with us you will have around 18% tax, because it will be 70% short term and 30% long term. So that we had done an analysis, if you remember, right, where we compared these different funds, and what
Correct.
we realized was that even if, let's say, we are paying this tax liability, which is higher, we end up doing better than the mutual funds in the long term if only we are able to beat them by 3% or 5%, right?
Correct.
Which,
Correct.
as the data shows, we should be able to do, or and we have been able to do in the last 1 year.
Yep.
So,
Absolutely.
yeah.
There's a question from Mr. Ajay. I'll just quickly try to answer it. In the PMS, can Wright Research itself choose a strategy for me or percentage allocation in different strategies? We do. We can obviously tell you what type of strategies you should invest in the 3 4 portfolios that we have, and that can be done on a call with you, depending on your own sort of risk profile, etc., etc. Um, Mr. Majid is asking, is there a share? Can we also share any churn percentage of the PMS portfolios if we can just give some high level numbers?
Yes. Yeah, definitely. So see, we have seen churn, but it hasn't been an extremely high churn. Churn for the last year had been around uh, between for our various strategies between 150 to 250%, right?
Yeah, in that range. Yeah. Yeah. Last one or two questions here. Mr. Shiv Fani Kumar is asking, what is the HNI quant small case? If you can share, maybe a couple of
So
sentences.
HNI quant small case is a specialized small case, a multi-factor small case that we launched only for people who want to invest larger capital in that strategy, right? So it is limited. It's a higher cost and it has a limited access, right? Only a limited number of people invest into that, and the even the investment amount is 5 lakh plus. We recommend that you go more than 25 lakh in that strategy. So good way to for you to build a longer corpus uh, on a small case structure. And yeah, I think that's what the intention there is, right?
Yeah. Cool. I have just one or two more questions, and that's it, Sonam. Mr. Malik is asking, shall right momentum or any of our portfolios go to cash when there is bloodbath on the street, especially in like a very severe
Yeah,
market
yeah.
crash?
So I was talking to one client yesterday, and they were saying that first time investing into quant strategies and all, what happens in times of risk. So here, actually, if you compare a quant strategy to somebody who is investing based on a theme or a story, so that what you will notice is the person who is doing quant ends up doing much more proactive risk management. We sell whenever we see the risk, whenever we see that things have become a little bit risky. We will be the first people to sell, right?
Yeah.
We are also much more diversified, so we have all that built into the system. You might see one person become very biased towards a theme and invest maybe all into, let's say, railways and defense, and then see this sharper correction, whereas quantitative strategy will be much more diversified, right? Much more tactical. So you will actually see a better risk management in quant strategies in comparison to other strategy. You will see that in our small cases for the last 5 years data, if you go and look at it, and in the PMS also. I think in due time you'll realize that.
Sure. And I'm sure, I think the max drawdown and the return numbers you can, Mr. Malik, you can find on our website. We have a section under each of the small portfolios that we have where you can,
Right.
get more insights into the portfolio, and that typically shares most of the metrics. Mr. Shrikant was asking, and this is the last question we have for today. He's been investing in the momentum small case for the past 2 3 years. Should he continue with the same? Should he invest in, let's say, the alpha small case? Any high level suggestions here?
Uh, See, I think both of them are interesting portfolios, very similar sort of portfolios. Momentum is a 20 stock and Alpha is a 10 stock portfolio. If you have both the portfolios, what you realize is typically similar sort of stocks are there in both of them. So, if you have momentum, I won't recommend that you sell and move to Alpha. But if you're looking at slightly high risk momentum strategy, then you can definitely look at that one as well, right?
Oh, absolutely. I think with that we can probably wrap up today's conversation. I think we've answered pretty much all or most of the questions if we've not had any more.
Yeah, yeah, this was a long one, and thanks to everyone who stuck around. And it was really fun, like all of our live streams. Um, So thank you everyone for joining us on a Sunday. People who are interested into the PMS, please do go to our website. There is a leads link through which you can book a call with our sales team, Shivam and Pratishta from my team. They'll attend to you, and we have a very strong team who will be happy to help you in your journey. With that,
Absolutely.
we'll just thank everyone. Thank you for attending, and we'll see you soon in our next live stream.
Absolutely. Take care. Bye.
Bye. Done.